Hello there! Lecture Series 24 of Bite-Sized Corporate Reporting focuses on IAS 12 Income Taxes. This is a two-part lecture series. The objective of IAS 12 is to prescribe the accounting treatment for income taxes, principally the issue of how to account for current and future tax consequences. Hence, the tax liability or asset recognized in the statement of financial position comprises two elements, that being current tax and deferred tax. As a result, the tax expense recognized in the profit or loss comprises of 1. Current tax expense and 2. Deferred tax expense, representing the movement in deferred tax liability or asset. Current tax is the amount expected to be paid to tax authorities in relation to current year trading activities, applying tax laws and rates in force at the reporting date. The current tax payable is recognized as an expense in the profit or loss, with a corresponding recognition of a liability for tax payable. It is important to note that in most cases, the current tax payable is an estimate, with the final amount payable being finalized after the financial statements are authorized for issue. Therefore, if the actual tax payable exceeds or is less than the estimate recognized, this would result in either an increase or decrease respectively in the current tax expense of the next accounting period, accounted as a change in accounting estimate in accordance with IAS 8 accounting policies, changes in accounting estimates, and errors. IAS 8 is covered in Lecture Series 14 of Bite-Sized Corporate Reporting. On the other hand, deferred tax is a consequence of the differences between the principles in an accounting standard and tax rules in a jurisdiction, resulting in accounting profits not being the same as taxable profits. As such, deferred tax recognition is an application of the accruals concept to match the tax effects of the transactions with the accounting treatment, and is not a tax liability levied by the government that needs to be paid. The differences between the principles in an accounting standard and tax rules could be either temporary or permanent differences. IAS 12 requires entities to account for deferred tax on temporary difference, as based on the application of the accrual concept, the tax effect of a transaction should be reported in the same accounting period the transaction is recognized. In the case of permanent difference, IAS 12 stipulates no deferred tax shall be recognized, as the difference will never be eliminated. So, how do we determine temporary differences? A temporary difference is the difference between the carrying amount of an asset or liability in the statement of financial position and its tax base. Tax base of an asset or liability is the amount attributable to that asset or liability for tax purposes. The final part of Lecture Series 24 will look at recognition and measurement principles of deferred tax as set out in IAS 12 Income Taxes.